Hi, my name is John Weir. I'm a first vice president with Marcus and Millchap in our South Bay office. For those that don't know, I specialize in multifamily sales, helping private clients with anything from a 4-unit to a 100-unit apartment complex. Right now there seems to be a lot of interest in investing out of state, but there seems to be some concerns and insecurities with going out of state and doing the deal themselves. So to the right of me is someone I'm extremely excited to introduce. He's a successful multifamily investor since the early 2000s, and excited to introduce him. So John, why don't you introduce yourself and share with the audience kind of what you do?
My name is John Ward, and I'm with Turnstone Capital Management Group, and we are a group that syndicates apartments both in California and out of state. I happen to also be Jonathan's uncle, and am proud to have such a successful nephew working in real estate.
Thanks for that. So I guess what got you, you've been doing this for a really long time, what got you into the business? Like, walk us through the early John Ward days and now where you're at.
All right, so early John Ward days go back a long way. I started in finance as a loan officer doing commercial and also FHA VA loans. And then in 1997, we opened up the first version of Turnstone, which was primarily a flipping company where we started doing buy, fix, and flips. And we found a niche in our market where we could buy multi-unit properties that were more than 4 units, so 5, 6, and 7-unit properties, and then convert those down to 4 units. And so we had a good run. We would get a pop for the renovation, and we would get a pop for the convert down to the 4 units for the financing. And we didn't realize it, but we were basically acting as property managers because we had probably had 50 projects going of 5 to 6 units, and we were evicting tenants, and we were renovating units and leasing. And then one of my agent friends said, hey, there's a 16 unit in Long Beach. And we ended up buying the 16 unit in 1998. And the rest is history. We've been doing.
Open the doors for you to get the bigger deals.
Yeah.
I love it. Wait,
great.
So now fast forwarding from 1997 to 2021, how many units do you guys have under asset management?
We basically had 2 runs. We had 500 units back before the Lehman crisis, and we ended up selling a number of those units and then trading into properties in Texas. And so back then we had about 1,800 units, and we ended up keeping 500 units through the whole Lehman crisis and all of that. The rest got sold. And when we formed the new Turnstone in the end of 2014 or early 15, we started purchasing again. And now we have 1,800 units in California and Texas with an AUM of about 200 million.
So you guys have 200 million under asset management, almost
200
2,000 units going into Phoenix, which we'll talk about. You got Texas, Southern California. What are you guys now, like in 2020, 2021 and beyond, what are you looking for in a potential acquisition?
So we have a very narrow focus, and we have 3 or 4 criteria that are very important. The first thing is we want cities that are experiencing a higher population growth than the U.S. is projected. So we all know the cities that are very popular. Everybody knows Dallas is growing in population, Houston, Phoenix. Those type of cities are enjoying job growth and population growth, and so we believe that increased demand will be very good for apartments. The other thing is that we invest in what we call workforce housing apartments or C-class apartments, and these are apartments that you are purchasing less than the cost to replace. And so there will never be any more of these apartments because you can't replace them. You can't build with and compete with my rents. So we have a supply and demand thing where we have a static supply and an increasing demand, and we believe that creates value.
Gotcha. So you're looking for markets where people are coming into, and you're looking for C-class workforce housing where you can prove it, but still even your all-in cost is still less than the replacement cost.
Absolutely. And then we add a value-add component to it. So we we don't do super heavy like new construction value add, but we take units that are tired compared to the market they're in and improve those units to be slightly better than the market they're in. So we build a better mousetrap, and that way we can attract the best tenants with the individual submarket.
Yeah, you guys absolutely kill on the rehabs. I mean, I work with a lot of clients who do unit turns, but they're not quite as good as what I've seen you guys do, with just understanding what kind of backsplash, countertops, cabinets, the lights. I mean, really everything. And so I've seen you guys get rents that other people just can't, with little, not so costly differences in your renovations.
Thanks.
Yeah, absolutely. Let me ask you. Let's get into some of the challenges, because you deal with some ups and downs, and construction always has some contingency. What are some of the main challenges you guys experience in your deals before stabilizing them?
So on the macro level, I think the most inefficient business in the world is construction. And you think about it, if you wanted to order a car and General Motors was going to make your car and you paid a price for it, and then they came back when it was over and said, oh, I'm sorry, we're going to charge you 20% more than the car. Or if you went to go buy groceries and you went to the checkout line, they're like, it's going to be 20% more. Construction is so inefficient. They're always over on budget, and they're always over on time. And I don't know how they've gotten away with it all these years, but it will drive you crazy. And so that is one of our biggest challenges. And then it is working within, getting to know the markets. And we spend a lot of time to get to know individual markets. I'll give you an example. You buy units in Long Beach, California, and 2 and 3 bedrooms are a premium, because the more bedrooms you have, people stay longer and you get premium rent. Well, you go to Texas, and the 2 and 3 bedroom units, the rent you charge is often equal to what somebody would pay for a house payment. So you actually lose a lot of tenants for home ownership. Whereas in California, if they're paying $1,800 or $2,000 for a unit, they're not going to be able to buy a house with a payment for that low. So you can't take your Southern California knowledge and bring it to new markets. You have to really learn the new markets. So we spend a lot of time working with the agents in those areas and working with property managers in those areas and really learning the markets. And this has helped us invest.
So let me ask you this. What's your most rewarding, favorite part about your job as an operator?
My favorite part about the job is finding value in a specific investment that other people don't necessarily see. So I'll give you an example. Formal dining areas are not as popular as they used to be. And in California, a lot of developers will take a formal dining room and they will convert that into a bedroom. So you take a 2-bedroom unit with a dining room, and now it becomes a 3-bedroom unit. So very cheaply, you just add a wall and you have a bedroom with a door. And out of state, developers don't do that, or they're not aware of that practice. So we will buy say a 300-unit building, and 120 units are a 2-bedroom with a really nice office, or a 2-bedroom with a really nice dining room, and we'll turn that into a 3rd bedroom. We're creating value that way, and there's things we do that.
And then your pro formas are so much higher than everyone else's, because they didn't even think to do that.
It makes it a much better return.
I love it. So what project specifically can you think of that was the best project you're the most proud of? Maybe something that when you did that strategy, or something even totally different?
We have a lot of projects that I'm really proud of. Specifically, we have one in California that is on Avalon Boulevard in Wilmington that we purchased, and we noticed, even though the building was all single units, meaning they had no bedrooms, they were listed on the county title record as having all 1-bedrooms. And they also were configured in a manner that we could easily add a bedroom and still have a really nice unit. So we went in as part of our renovation, and we added a bedroom to every single unit in the building. The configuration came out, the returns are through the roof.
I've seen that. I drive by that building all the time. I know the building
Yeah.
because one of our brokers sold you the deal. You guys absolutely crushed it on that thing.
Yeah,
$1,700 for a 1-bedroom in Wilmington.
Yeah, well, also, we use other cheap materials, like you've seen the metal siding that we did on
It looked
the
good.
outside.
It looks modern.
Yeah. And that's like $1 a square foot, and it's super modern, and it changed the whole complexion of the building.
Yeah, it's amazing. So, look, the reason I'm excited to do this video, you guys have done extremely well in Southern California, but you guys are absolutely crushing it in other metros across the country. Phoenix is extremely hot. I know we're in a couple deals in Phoenix right now, and you've already have some units under management in Phoenix. What's so exciting about Phoenix?
Phoenix is amazing. First of all, the cost of living is very, very low. There's, when comparing to other markets we're in California, you have high cost of living and you have earthquakes and you have a lot of regulation. In Phoenix, you don't have earthquakes, you have low cost of living and you have minimal regulation. And as well, it's 1 hour from Los Angeles, so people actually commute to Phoenix to work. And it used to be in Phoenix where there would be a recession and the top 5% of tenants would be construction workers, and they would leave, so you'd start a recession at 10 and go down from there. And that's changed now that there's all kinds of headquarters, business headquarters moving in,
It's
populations
crazy.
moving
Crazy.
in. Yeah.
Yeah, I was just there a few months ago, and there are so many office buildings, but they're not like vacant. You can tell that a lot of companies are moving there just because of all the things you mentioned.
Yeah, the other day we were going to a building and we're in Uber, and the Uber made a wrong turn and he pulled in a parking lot, and I looked next to me and there was a U-Haul there. And one of the advertisements that we do is what U-Haul charges one way coming from Los Angeles to Phoenix and from Phoenix to Los Angeles. So if you want to rent a U-Haul from Los Angeles to Phoenix, it's $900. If you want to rent a U-Haul from Phoenix to Los Angeles, it's $149.
It's crazy how much cheaper things are.
We happened to pull right in there and there was the U-Haul, and told the Uber driver, stop, I want to take a picture of the sign. $149 to Los Angeles.
I mean, you think about this, the notion 30% of your income should be allocated towards housing, something like that, right? In California now, especially Southern California, it's close to 45%, right? But you look at a place like Phoenix, like statewide insurance, State Farm, and some other big companies are moving out there, and they're paying their people like $50,000-$60,000 a year, but a 1-bedroom's like less than $1,000 a month, right? So there's still so much upside. I think they're paying maybe 20-25% of their income, and there's so much room for them to. Tenants don't want to pay more, but there's still more room for them to pay more. So I'm saying, right?
Think about. I go to Pete's Coffee over here all the time, and the manager is a single mother. She makes $45,000 a year, and she lives in Hawthorne, and she lives in a 3-bedroom apartment with 2 other roommates, and she has childcare, and she can barely afford to make things, keep things going. If she lived in Phoenix, her rent would be, $800, and she'd have an extra bedroom for her son, and she'd have a pool, and she'd have a gym, and she'd have everything, and cost of living would be so much lower,
Yeah. So walk me through. I'm an investor. Maybe I have an apartment building and I want to sell it and I want to invest with you. All the proceeds. I have a $2 million 6-unit building here, and I've talked to you and I like you and I like what your business model is. Walk me through the first 3 years of the investment. I give you $2 million, just as hypothetical. Like, how does this work?
Okay, so with the first thing we do is we get to know each other, and I talk about what our investment thesis is, and I have to understand your investment goals, because I want to make sure we have a fit, and I also want to make sure we have a personality fit. And then the next stage is to go through my models, and you need to understand my assumptions that I make on my deals, and you kind of climb in my head, and I show you how we analyze the deal. And from that point, you can get a pretty good feeling, and I get a good feeling whether we have a good match. And at that point, we put you on our investor list, and about every month or month and a half, we're coming out with a new deal that we're purchasing. And I will send that out with a write-up and an offering memorandum and a model, and I'll put out an email to everybody on the list saying, hey, if you're interested, let me know as soon as possible. And if you'll review it, and you'll get back to me and say, I want to invest. And at that point, we will, fill up the transaction with all the investors that need to invest. And we create an operating agreement for the LLC that's going to own the property. And every transaction, by the way, is a separate entity, and it's separately accounted, so there's no commingling of anything. And we go through the escrow process where we're doing our due diligence on the property, we're making our inspections, we're doing everything that's needed, appraisals and phase ones and property condition assessments and those kind of things. And then we get ready to close escrow, and we'll have you sign the operating agreement, and you'll wire your funds into our property account, and we'll close the escrow. And depending on the transaction, then we get into the rehab phase. So most of our transactions, we are turning tenants, where we're shuffling through tenants and renovating the units as we create occupancy on the property. And that will go about 18 months. And at that point, we refinance the property and stabilize. And we like to do investments for about 5 years. And if they're going really well, maybe we'll keep it longer. And maybe if we get a super upside, maybe we'll sell it earlier. But we look to do about 5-year investments.
Okay, so I just gave you $2 million out of an exchange. We found a good deal. First 18 months, like you said, you're going in and turning the units, renovating them, and now the rents are maybe even 100% higher, right? You guys have increased the rents by several hundreds of dollars, and therefore the property's gone up.
Yes.
The value of the property's gone up.
That's
and
correct.
So then you refinance, and generally some of the money that I've invested of the $2 million I gave you comes back to me, right?
That's correct.
Generally, how much? Just give us a range.
It depends on the transaction, but anywhere between 25 and even up to 50%.
All right, so in some cases, I give you $2 million, and a year and a half later, I could get $1 million of it back.
$1 million back.
In tax-free money,
Well,
right?
tax deferred.
Tax-deferred.
Yeah, you're pulling out your money, and then you can invest that money, and until we sell the property, if we don't exchange the property, you get that money tax deferred, and so you can make money on your money.
Money, right.
Yeah.
So it's
until
amazing.
you-
I mean,
yeah,
it's
no,
awesome.
Yeah.
A lot of the clients that we work with don't get the opportunity. They don't understand how to do it, and they don't want to roll their sleeves up and do the work and really increase the value like you guys do. I think it's awesome when you're able to refi and get some of the money back.
Yeah, we also do a thing called tax segregation, cost segregation for our taxes. So typical depreciation is the value of the asset minus the land divided by 27 and a half years.
Right.
So that's your depreciation. So we do what's called cost segregation, where we can actually depreciate the materials that we take out of the property, the cabinets that we throw away, and the counters still have some value. You can depreciate that with no recapture.
It's insane. I love the concept. It's
Yeah,
so
I
crazy.
know, and we can save a lot of money for the vast majority of the cash flow you will receive on an investment with me, you will not pay tax on until the property is sold, and then it'll be at the recapture.
It's crazy. Okay, so that was my next question. So,
sorry.
So, so how often are investors getting cash flow distributions from Turnstone, and what would like a cash flow percentage? Just give us an idea of how that works.
So we do financials and distributions every single month. All right.
So that's different than other syndication groups.
Most do quarterly,
Yeah.
and some do every 6 months.
It's way better. I think monthly makes it more of like an annuity, right?
The more you pay people money, the more they want to give you money back. I found that generally works for me in my business. But we do financials and a property report, and we do distributions every month. A lot of times during that first 18-month period, the distributions are a lower percentage. So your annualized return on money may be 2 to 5% during the first 18 months. And every month you have a preferred return, meaning that before you get your preferred return as an investor, say 8% preferred return, I see $0 out of it. So I'm very incentivized to try to get you up to that, fix up the property and get it refinanced. Once we do the refinance, we pay you back some of your principal, and then we start doing monthly distributions, and generally our stabilized returns are anywhere from 10 to 15% annualized return.
So that's incredible though. Like even if it's a 7 or 8% preferred return, that's like double what most of Southern California apartment clients that I sell their buildings for are getting, right?
Yeah, Southern California is a different market.
Yeah.
The land is so expensive. You're paying for land.
Right.
Okay. And in other markets, you're essentially paying for land and cash flow. You were going to get
So
more cash.
just to summarize, so in a typical investment, because I've invested with you guys several times, it's a 7 or 8% preferred return, meaning a 7 or 8% cash on cash. So if you invested $1 million, you'd make, what is that, $70,000 or $80,000 a year in cash flow.
Yes.
After 18 months, out of the $1 million you invested, you might get 500,000 of it back, or maybe a little bit less. So now you're actually making even more of a cash flow percent.
Well, but remember, it's the return is based on the money you have left in
the deal. Okay,
so
right.
If you give me two,
Right.
you're going to get a preferred return based on the $2 million. If I give you $1 million back and you get a 15 or 12% return,
It's
that's
based
going to be
on-
120,000 on the remaining
Right.
million.
Right, and it's just amazing. That's awesome, right? And
It's
then
a great
it's
return.
super passive. There's no taxes on the cash flow because you do the
Minimal.
cost seg, minimal, very
Minimal
minimal,
taxes,
and maybe
yeah.
at the end of the hold on. A lot of the clients that we work with, I don't know if I mentioned this. They like to exchange in the single tenant triple nets, like a Burger King out of state, just because it's totally passive. Which what you do is passive for them too, but you have like a corporate 15-year lease. Tenant pays for everything. I love those deals, but some people want to be exposed into multifamily still. They're not totally comfortable getting into like retail. There's DSTs out there. There's a couple local companies and national companies where these clients can invest into a DST. What are the differences from a DST in Turnstone Capital?
So a DST feels much more like a triple net, like what you do. Okay, it's a 15-year investment. It is, you can also do the deduction, the 1031 exchange.
Right.
I can work with you on a 1031 exchange. With my investment, it is a multifamily investment, just like we've described, where you're going to hold it for 5 years. We can do shorter term investment. If you come to me and you say, hey John, I got $2 million, but I want a 36 to 48 month investment, I can find something that is more of an increase in value, where we're going to do a value add and we're going to get out of it more quickly and get your money back. DST is a long-term investment. It's locked in. You get X amount of payments per month. And I look at it for an exchange client. If you're not going to do a triple net and you want to get a little bit more alpha, a little bit more return on your investment, the DST is like a parachute for you. If you can't find something with a person like me that's going to syndicate a deal and get you a higher return with an 8 pref and a projected 18 or 19% internal or annualized return, I look at the DST as an option for you, only to prevent you from paying
If
taxes.
the airplane's going down,
Yeah,
right?
the
And you
airplane's,
gotta
put the
just
parachute on, I save my taxes, I get my 5 or 6% on my DST, but it's locked away for 15 years.
see. That's the thing I don't like about the DSTs. I've only helped a client get into a few. Most of it's single tenant triple nets because I like those. It's fee simple. They can sell whenever they want. They're extremely liquid. You can sell a triple net property within 60 days. I like putting clients into syndications with guys like you because it's a little bit more customized. You're a local guy here and you really want to work with them and you can create a strategy that works for both parties. DST seems a little bit more, it's a 7 or 10 year hold. You're invested with so many other people. It seems like there's less control for the investor.
It's a corporate deal.
It's a corporate
not-
deal.
Yeah. So let me give an example. Last November, we purchased 214 units in Phoenix with a group out of Denver. And, everybody knows we've been hit with some pretty negative happenings this year with COVID and everything. This property has $70,000 in current delinquent rents from people that have a COVID CDC issue and we can't evict them. I am outperforming my model year to date with 60,000 more net rents than I projected in my model, despite having the delinquencies on the COVID. So when we get to the end of the 18 months, I will have gotten to those projected rents in 12 months. So I'm 8 months ahead of schedule on my rents. I'm turning my units, and we're already looking at it based on where the market's going in Phoenix. Like, maybe we want to get out of this thing in
early.
24 months, and we'll be able to outperform the model that we projected in 5 years in 24 months.
Yeah, that's
so if
exciting.
you buy right and you do it right, even COVID is not going to knock you on your butt.
Yeah. So how can people get in touch with you? after watching this video, that, you know, they can obviously reach out to me and I can make the introduction. But what's another way?
That's one way, would be reach out to Jonathan, and my email is john@turnstone.com, which is JOHN@TURNSTONE.com. And I also have a cell phone, which is 310-874-3311. That's right.
I love it.
Yeah,
I love it.
Always
Well,
available. 24/7.
I appreciate you coming and doing this video.
Yeah, my pleasure.
Great guy, super successful, knows the ins and outs of the multifamily game, and he could be a great asset to you guys as well. So
Let's
thanks.
do some deals.
Let's do some deals.
Yeah.